Hi everyone, it's Vinay with My Mortgage Professor. Hope you're doing well. Today we're talking about the Supercharged TFSA that you can place in your corporation or in your personal hands. It's one of the most advanced and smartest investment vehicles that you could use for your life insurance and estate planning. Let's have a look. So what if I'd mentioned to you that you could invest personally or in your corporation in a product that grows tax-free, and you can take it out as a pension tax-free in retirement? Now, if you own a corporation like I do, we're pretty limited. There is no TFSA. But what this is, it's a permanent life insurance policy. You can either own it yourself or in your corporation. It works really well if you've got $100,000 in retained earnings or if you're a disciplined saver. If you're doing this personally, you want to be already maxing out your TFSAs or RSPs. And again, if you're in a corporation, you want to make sure you've got at least some retained earnings in there. The key here is that it's paid with corporate dollars. We get taxed 12% in our corporation versus 36%, let's say, at your marginal tax rate. You prepay the policy either over a 10 or 20-year period. And this is an asset, and it grows over time tax-free. There's literally no MERs or management expense fees. It's around 0.2%. And historically, it's grown around 6.2% over the last 25 years. So it grows very steady. It's kind of like a steady Eddie growth. It doesn't fluctuate. You can see it relative to the CPI index or inflation. It's done pretty well relative to the S&P and government 5 and 10-year bonds. Here's how the dividend responds to market conditions. So this policy in your corporation, let's say, is the yellow line. You can see since 1995 till 2019, it's remained pretty stable, whereas the market in red has fluctuated quite a lot. And it's comparable to some of the government 5 or 10-year bonds. Again, it's averaged around 5 or 6%. So let's have a look at how it works. If you have extra retained earnings in your corporation, you have it saved in there, or better yet, if you have a holding company, you can buy a life insurance policy where your corporation is the beneficiary. You, as the shareholder, will get the proceeds tax-free, or your spouse in this case, and it goes to your corporation. It flows through something called the capital dividend account, which essentially grinds the adjusted cost base down to zero over time. And it's a tax-free payment to your shareholders. So let's look at my own example.
Here's an example of what my Supercharged TFSA looks like. I've got mine through Manulife. So I've got my permanent insurance for about $215,000. The remainder I have through term insurance. My first annual premium is roughly this much. So of course, this is all dependent on your budget. If you're a corporation and you've got some extra retained earnings, this is perfect for you. If you are an individual, and I would say the caveat is that you max out your RSPs and your TFSAs and you've got extra income. Some of my clients will do $250 a month, all the way up to say $20,000 in a year. So it really does fluctuate. But for mine, I prepay $15,000 a year for 10 years. After that, I stop paying this. But the nice thing is compound interest and, of course, time value of money. So it starts to build a cash value right away around that 5 to 6% dividend yield, which I talked about. If I hold the policy till life expectancy, let's say around 86 years old, the death benefit would be over $1 million. So it's about a 6 times multiple return on investment on this. It's quite powerful. What you can start to do, though, as I'll show you here in my next PDF, is you can actually start to take out a pension from the value of the life insurance policy. So again, my annual deposits, let's say they're about $15,000 a year for 10 years. But it starts to build, and then what I can do anytime I want, let's say I retire at the age of 65, my policy is now worth this much. I can go to the bank and take about 90% of the value of this as a loan. I can collateralize it, they'll give me a loan because it's a prepaid asset. And for me, until my life expectancy, they'll give me about $22,149, or about that $1,800 a month that I showed you earlier, tax-free as a pension for every year up until my life expectancy. What's nice is that my estate is still going to have somewhere around $284,000.
So it's important to note, if you get a personal pension like CPP, those pensionable earnings are taxable. So for example, if you get $1,000 a month in retirement through CPP, you're only going to net maybe around $800. With this what you'll do is you'll prepay whatever's in your budget. For me, it's $15,000 a year for the next 10 years, and I prepay my policy. There's also payment options for 20 years, and you can have a range anywhere, say between $250 a month or $1,000 or $2,000, whatever is really in your budget. Then what you can do is collateralize that life insurance policy, take it to a bank when you're 65. They will actually give you a loan on that policy. In this case, for my numbers, it will pay me about $1,845 a month, tax-free until my life expectancy at 83. At that point, my estate or my family still gets around $280,000 tax-free upon my death. And again, that will flow through the corporation to my beneficiaries tax-free. So looking at my initial investment of $150,000, if you look at the numbers, it's around a 6 times multiple return on investment. There's no better way to start to supplement your investment or your tax-free pension than this type of a policy. So if you have any questions on how to set up a supercharged TFSA, either personally or in your corporation, let's run some numbers together. You can always reach me by phone, 403-690-7376, or by email, vinay@mymortgageprofessor.ca. Thanks for watching.